Standard deduction. The standard deduction is a flat dollar amount that reduces taxable income without requiring the filer to list individual expenses. For the 2025 tax year, single filers deduct $15,000, married filing jointly deduct $30,000, and head of household filers deduct $22,500. Taxpayers age 65 or older receive an additional $2,000 if single, or $1,600 per qualifying spouse if married. According to IRS statistics of income data for tax year 2022, approximately 9 out of 10 taxpayers claim this option. The Tax Cuts and Jobs Act of 2017 roughly doubled the standard deduction, which explains why that share is so high. The main trade-off is simplicity over precision. A filer with large mortgage interest or high state taxes may reduce their bill further by itemizing instead. Itemized deductions. Itemized deductions are individual expense categories listed on Schedule A of Form 1040 that collectively replace the standard deduction when their total exceeds the flat amount. The main categories include state and local taxes, mortgage interest, charitable contributions, and medical expenses. The state and local taxes deduction, called the SALT deduction, is capped at $10,000 per return through 2025 under the Tax Cuts and Jobs Act. Mortgage interest is deductible on loan balances up to $750,000 for loans originated after December 15, 2017, per IRS Publication 936. Medical expenses are only deductible above 7.5% of adjusted gross income, a threshold made permanent by the Consolidated Appropriations Act of 2021. Itemizing makes financial sense primarily for homeowners in high-tax states whose deductible expenses collectively exceed their standard deduction amount. Above-the-line deductions. Above-the-line deductions, formerly called adjustments to income, are claimed on Schedule 1, Part 2 of Form 1040 and reduce adjusted gross income directly. They are available to any eligible filer regardless of whether the filer itemizes or takes the standard deduction. Common examples include the student loan interest deduction, the educator expense deduction, health savings account contributions, individual retirement account contributions, and the self-employment tax deduction. The student loan interest deduction allows up to $2,500 per year. It phases out for single filers with modified adjusted gross income between $85,000 and $100,000 in 2025 per IRS inflation adjustments. The educator expense deduction covers up to $300 per eligible K through 12 teacher for unreimbursed classroom costs. Because these deductions lower adjusted gross income, they can also improve eligibility for other income-tested deductions and credits. Contributions to traditional pre-tax retirement accounts reduce taxable income in the year the contribution is made. The traditional IRA deduction limit is $7,000 in 2025, or $8,000 for those age 50 and older. Deductibility phases out for active workplace plan participants, single filers between $79,000 and $89,000 in modified AGI, and married filing jointly between $126,000 and $146,000 per IRS 2025 IRA limits. For workplace plans, the 401k employee deferral limit is $23,500 in 2025. Self-employed workers using a simplified employee pension IRA can deduct up to 25% of compensation or $70,000, whichever is less, per IRS Publication 560. Roth contributions receive no current year deduction. The tax benefit comes at withdrawal, not at contribution. The trade-off for pre-tax accounts is that all withdrawals in retirement are taxed as ordinary income. The health savings account deduction applies to contributions paired with a qualifying high-deductible health plan. The 2025 contribution limits are $4,300 for self-only HDHP coverage and $8,550 for family coverage, with an additional $1,000 catch-up for account holders age 55 and older. To qualify, the health plan must carry a minimum deductible of $1,650 for self-only or $3,300 for family coverage in 2025. A family that contributes the full $8,550 reduces their AGI by that amount in the contribution year. The HSA has a structural advantage over a flexible spending account. Unused balances roll over indefinitely and can be invested. The HDHP requirement means higher out-of-pocket costs before insurance coverage kicks in. Self-employed individuals have access to several above-the-line deductions not available to employees. They may deduct 1/2 of all self-employment taxes paid because the self-employed pay both the employee and employer share of FICA, which totals 15.3% of net earnings. The deductible half equals roughly 7.65%. Self-employed workers can deduct 100% of health insurance premiums paid for themselves, their spouse, and dependents, provided no employer-subsidized plan is available to them, per IRS Publication 535. Home office costs are deductible using either the simplified method, $5 per square foot up to 300 square feet, or $1,500 maximum, or the regular method based on actual home expenses. W-2 employees cannot claim the Home Office deduction for tax years 2018 through 2025 under the Tax Cuts and Jobs Act. Business expense deductions. Under IRC Section 162, businesses can deduct ordinary and necessary operating expenses, including rent, salaries, utilities, advertising, office supplies, and professional fees. For capital assets, two acceleration methods apply. Section 179 expensing allows an immediate full deduction for qualifying equipment placed in service during the tax year, up to $1,220,000 in 2025, with a phase-out beginning at $3,050,000 in total purchases, per the IRS 2025 inflation adjustments. Bonus depreciation offers a first-year percentage deduction on eligible property. That rate was 100% through 2022, dropped to 60% in 2024, and falls to 40% in 2025 under the Tax Cuts and Jobs Act scheduled phase-down. Business meals remain 50% deductible, while entertainment expenses have been entirely disallowed since 2018. The standard mileage rate for business vehicle use is 70 cents per mile in 2025, per the IRS Annual Mileage Notice. Scene 8. Charitable contribution deductions. Charitable deductions are an itemized deduction on Schedule A for gifts made to qualified 501c3 organizations. Cash contributions are deductible up to 60% of adjusted gross income. Donations of appreciated property, such as stock held longer than 1 year, are generally limited to 30% of adjusted gross income, per IRS guidance on charitable contribution deductions. For any single donation of $250 or more, the IRS requires a contemporaneous written acknowledgement from the receiving charity. Without it, the deduction is disallowed entirely. Vehicle use in service of a charitable organization is deductible at 14 cents per mile in 2025, a rate set by statute and not adjusted for inflation, compared to 70 cents per mile for business use. Donations of non-cash property above $500 require Form 8283, and donations above $5,000 generally require a qualified appraisal. Scene 9. Qualified Business Income Deduction. The Qualified Business Income Deduction, established under IRC Section 199A, allows eligible self-employed workers and pass-through business owners, sole proprietors, S-Corp shareholders, and partnership members to deduct up to 20% of qualified business income from taxable income. Per IRS 2025 inflation adjustments, income-based limitations begin phasing in at $197,300 for single filers and $394,600 for married filing jointly. Below those thresholds, most pass-through owners can take the full 20% without restriction. A self-employed consultant with $150,000 in qualified business income and single filing status could deduct up to $30,000. This deduction reduces taxable income without requiring itemization. The qualified business income deduction is currently scheduled to expire after December 31st, 2025, under the Tax Cuts and Jobs Act sunset, unless Congress acts to extend it. Net operating loss deduction. The net operating loss deduction applies when a business's or individual's allowable deductions exceed gross income in a given tax year, producing a negative taxable income figure. Under Tax Cuts and Jobs Act, rules governing losses generated after 2017, that NOL can be carried forward to future tax years indefinitely. But the deduction in any single carry-forward year is capped at 80% of taxable income for that year, per IRS Publication 536. Pre-2018 NOLs followed different rules, a 2-year carryback and 20-year carry-forward with no percentage cap. The CARES Act of 2020 temporarily suspended the 80% limit for 2018 through 2020 NOLs and allowed a 5-year carryback as COVID-19 relief. A business that generates a $200,000 NOL in 1 year and earns $100,000 the next can offset up to $80,000 of that income, carrying the remaining $120,000 forward to subsequent years.